ICICI Bank posted robust earnings in the third quarter of FY22. India's second largest private bank posted a net profit of 6,194 crores in Q3, a 25% growth compared to the same quarter last year. Though the operating expenses increased, profit growth was driven by market-leading loan growth, best-in-class margins, healthy fee income and lower credit costs and provisions. ICICI Bank has seen a major transformation across business verticals and financial parameters over the last few years. Balance sheet strength is paramount for a bank, and having achieved that, ICICI has seen strong earnings growth in the December quarter and is likely to maintain the same over the coming few quarters. Thanks to its superior funding profile, ICICI Bank's cost of funds is among the lowest and stood at 3.7% in the current fiscal. Low cost coupled with increased share of high-yielding retail loans boosted ICICI Bank's net interest margins on its domestic book to above 4% in 9 months of FY22, which is comparable with the best of the best. High margins along with healthy fee income and scope of improvement in cost-to-income ratio should help the bank deliver core pre-provision operating profit, which is the PPOP growth of more than 20% over the next couple of years. Moreover, with the bulk of problem assets already recognized and provided for, credit costs will be trending down. ICICI Bank has already achieved more than adequate provision coverage ratio of 80%, which is the highest, or rather among the highest in the industry. Moreover, the bank holds about 6,425 crores of contingent provisions, which is equivalent to 0.8% of its loan book. Overall, ICICI Bank has already achieved the targeted ROE of 15% and ROA could further improve to 2% in the coming quarters. Domestic loan book increased by 18% YOY, led by strong growth across SME, business banking and retail lending. Retail credit grew by 19% YOY. Corporate credit too saw good traction and increased by 12.5% year-on-year. Mortgages, which constitute around 55% of retail loan book, saw a 23% year-on-year growth. Other segments within retail, especially unsecured portfolio consisting of personal loans as well as credit card, posted a healthy growth of 23% and 32% respectively. ICICI Bank's market share in credit card business in terms of spends has improved from 14% in December 2020 to 21% as of November 2021. The impressive performance in cards business can be attributed to its partnership with Amazon, which has enabled the bank to acquire many new customers. Growth in total advances was a tad lower at 16%, given a 6% contraction in international loans. Now, this is of course in line with the bank's strategy to focus more on domestic retail business and reduce its non-India related overseas exposure. Deposit growth was healthy at 16%, mainly driven by a 22% growth in CASA deposit. Growth in terms of deposits was relatively muted at 12% YOY. Fee income grew by 19%, driven by growth across various segments. Fees from retail, business banking and SME customers constituted about 76% of the total fees in Q3 FY22. Operating expenses increased by 22% YOY, driven by higher employee expenses. Consequently, the cost-to-income ratio continues to be above 40% level despite higher income. Operating leverage should show improvement with higher thrust on technology and digital banking. Asset quality also fared better. Net NPA ratio declined to 0.85%, which is the lowest since December 2014. Restructured assets stood at 1.2% of advances book as of December end. ICICI Bank carries 25% provisions on restructured assets, more than the regulatory requirement of 10%. Provisions declined as bank did not make any COVID-related provision during the quarter. But despite that, PCR was stable due to better asset quality. ICICI Bank is more than adequately capitalized and well poised to capture the growth opportunities in the post-COVID period. At the current market price, the stock is trading at 2.3 times FY23 estimated core book value, which is reasonable considering that ROE has inched up to 15%. Moreover, ICICI Bank's valuable subsidiaries will continue to add to the stock performance. ICICI Bank has not only outperformed Nifty 50 as well as Nifty Bank in the past year, but it has also delivered significantly higher returns compared to HDFC Bank, the largest private sector lender in the country. While ICICI Bank stock has rallied 46%, HDFC has gained mere 3% in the last 1 year. Despite the outperformance, ICICI Bank's relative valuation still looks attractive. It has closed the gap with HDFC Bank on most financial parameters, whether it's funding profile, loan book, asset quality, provisioning buffer, capital position and most importantly, the margins. But it's still trading at a 28% discount to HDFC Bank. While ICICI Bank will continue to trade at a valuation discount to HDFC Bank till the time it demonstrates its ability to manage credit cycle risks, there is room to further narrow the valuation gap with HDFC Bank, which is trading at 2.9 times FY23 estimated core book value. ICICI Bank has successfully transitioned from being a turnaround story to a growth stock. With limited downside to earnings, it offers best risk return in the banking space.